All right, welcome to this week's Feedback Friday video, where I take the best question each week from the Market Pulse Discord and turn it into a short trading video. This week's question comes from a new member saying that they have got a weekly and a daily routine for scanning stocks, usually looking for the strong stocks moving back to ascending moving averages or stocks that are close to their 52-week highs. What I struggle with is how do I prioritize my watch list? Any tips? This video will be covering exactly that, how to prioritize your focus list each day. And it really boils down to four different things. Is it a leading theme? Is the stock liquid and volatile enough to move your portfolio? What setups and entry tactics are you going to be using to getting into that stock? And last but not least, risk management. So I'll turn off my camera so we can get into the presentation. First off, why is it important to prioritize your focus list? Having a plan before the market opens allows you to execute your trades completely free from emotional stress. Your stock selection, your entry tactic, position sizing, and your stop should all be predetermined. When the market opens, there's a lot of emotions, a lot of alerts, a lot of news coming through. You really want to just stick to the setups that you focused on, the stocks that you've selected. And if you reduce those random trades, you're going to get a lot cleaner results and you won't be as stressed emotionally. So first thing that I look for when I prioritize my watch list is the stock in a leading or an emerging theme? Off to the right, you can see William O'Neill, one of the best investors of all time, and someone I've learned so much from. And one thing that he's always focused on was getting the majority of his money into the leading stocks and the leading themes. And that's really the goal of swing trading. You want to buy the leading stocks in the leading themes. And according to William O'Neill's studies, he found that 37% of a stock's move is due to the stock's industry, and 12% of the stock's move is due to the sector. So, as we know with trading, there's no absolutes, but we can align as much probability in our favor before we take the trade. And you can do that by making sure the stock that you're trading is in a leading industry and a leading sector. Some recent themes in the market has been AI, just in general, semiconductors, data centers, biotech stocks, solar, and nuclear. Next up is liquidity and volatility. First off, liquidity for me, I use average dollar volume. I know a lot of people will use average volume, but the combination of the number of shares traded and the dollar amount or the price of the stock will create that average dollar volume. And for me, I'm looking for $50 million traded minimum each day. And the more the better. 50 million is an absolute minimum. If you have a smaller account, you could probably pull that down to like 30 million. And then if you have a larger account, I would say 100 million plus is probably needed. But stocks need to be liquid enough for institutional investors to take and build positions in. If it's not a liquid enough stock, you'll notice that the stock will trade way more randomly. You'll get a lot of more shakeouts, a lot of just random action. And really, that's going to put additional stress on your portfolio and on yourself when you're managing those trades. So the higher the liquidity, the better. Next up is volatility. The thing that I use for this is the ADR or the average daily range. And really, you could pick the time frame that you want to select for that. I think technically mine's 14 day, but really 14 day, 20 day, it doesn't really matter. But you're looking for a minimum of 4%. And if a stock can't move, it's not going to be moving your account. So the ADR, the average daily range of 4% means that in a average day, the stock will move in that range of 4%. The best stocks really are stocks that have over 100 million. I would even say over $250 million a day traded and ADR over 5%. That's kind of the sweet spot that I've found in some stocks. And you'll notice like early on in NVIDIA that NVIDIA's move that met the criteria. Right now, its ADR is probably a little bit lower than four. But Robinhood earlier this year, Palantir, Tesla before it made its massive move, and AMD. These are all liquid stocks that institutions can and have been building positions in for a very long time. They trade very smoothly. They pull back and respect key moving averages in round numbers. You're not going to get some random 20% gap down day that's not on an earnings call. But they're volatile enough to where when they do start trending, you can get a large portion of your account into these names and move your account balance in a real way. And I chose a big wave here to kind of signal the liquidity and volatility because if you're trying to surf, you're not going to be just surfing at your local pool. There's not enough water there. And if you're in the ocean, but the ocean's flat, it's the morning, there's not enough volatility in the waves to really catch something to move you along. So you want that combination of liquidity and volatility in your stock selection. Next up is setup and entry tactics. You always want to prioritize your favorite setup and entry tactic. So this gets mistaken a lot between what's a setup and what is an entry tactic. For me, my favorite setup is just a pullback to a support gap, and I'll pin the video that I did about that kind of setup in the comments here. And then the entry tactic for me would be an undercut and reclaim. So you should have your setup and your favorite entry tactic and prioritize that once it's a leading stock and it's liquid enough and volatile enough to move your account. If you're in a losing streak or you're just re-entering a market, make sure that you size down and only take your A plus setups. Um, I would say, like, really, especially if you're in a losing streak, I always go back to what I see as just a layup trade for me. I want, I don't want to be challenging the market. I'm already in a losing streak. I'm already not doing well. I want the easiest way to make money in the market. So I'm going to go back to my A plus setup and my A plus entry tactic, which for me is that support gap undercut. If it's a hot market and you're already getting traction, you've got plenty of exposure in the market and your portfolio is really ramping up, then you can expand to secondary setups, maybe high volume closes, earnings gaps, um, just a typical pivot breakout, anything like that that might be, I mean, that might be your favorite entry tactics and your favorite setups. But for me, that's the secondary stuff that I look for. And when you're getting traction in the market, you can expand your selection to those secondary setups to build exposure again in those leading themes in the liquid leaders. And last, but definitely not least, is risk management. We talk a lot about like what your trade risk is, which is just your stop loss divided by your entry price minus one. So if you're entering a stock at $100 and your stop's at 95, that's going to be a 5% trade risk. But it's really the combination of your position sizing and your trade risk, which make up the portfolio risk, the total risk that your portfolio is taking on that given trade. That should be how you kind of manage your risk. So for me, I always will have portfolio risk under 1% for any trade that I take. Now, that can be a combination of a 20% position size and a 5% stop. It could be up to a 50% position size and a 2% stop, but that 1% is pretty high compared to the majority of the trades that I take. I definitely won't go over 1%, but that is my limit. I found that the 0.5% in like kind of a 1/4% to a 0.5% is the sweet spot where it still allows me to get enough position sizing in where if I catch on to a winning trade, it can move my portfolio along. But I can take multiple paper cuts of those 1/4%, 0.5% losses and really not damage my account until I realize that I'm in a losing streak and I can size way down and get that portfolio risk lower. And then trade risk, if you have your stop more than 7% below your entry, chances are you're not trading like an A plus setup or not even like a B or C plus setup. Just be patient and really let the stock set up to where you can take a trade where your stop is within 7%. That's a maximum. The sweet spot for me is that 2 to 3% with the undercut and reclaims of support gaps. Very often my risk will be 1%, and then 1 to 2% on those trades. So again, going back to that like A plus setup for me, the combination of the um, position sizing being allowed to be much higher because the trade risk is so tight really lets me get into some key names at some key spots. So those are the four things that we'll cover for this video. If you guys enjoyed it, make sure you sign up for Market Pulse. If you're already in the room, make sure that you're using the question and answer section. So your question can be featured next on the next Feedback Friday video. I hope you guys enjoyed it. Have a happy Halloween, and I'll see you guys in the next video. Take care.